In today's global economy, cross-border tax planning isn't just an option. It is a necessity for every business growing internationally. In our last video, we looked at the essential role tax advisors play in guiding businesses through cross-border taxation. In this video, we will break down 4 key areas of cross-border tax planning that every international business must navigate to avoid penalties, reduce tax exposure, and optimize their operations globally. Whether you are new to international markets or ready to sharpen your tax strategy, this guide will give you the insight you need to move forward with confidence.
Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos.
Let us start with transfer pricing. Transfer pricing involves setting prices for transactions between different subsidiaries of the same company, whether for products, services, or intellectual property. To prevent unfair profit shifting, transfer pricing follows the arm's length principle. This means that transactions should mirror pricing that would occur if the entities were independent. That is where tax advisors come in. 3 key roles of tax advisors in transfer pricing are policy development and strategic planning, documentation preparation, audit support, and dispute resolution. Tax advisors help businesses develop transfer pricing policies that are tailored to their specific business model and the jurisdictions they operate in. These policies ensure compliance while optimizing tax efficiency by considering the functions, assets, and risks associated with each entity in the transaction. Advisors also prepare necessary documentation that includes detailed functional and economic analysis, benchmarking studies, and explanations of pricing methods. The document acts as a key defense during tax audits, reducing the risk of disputes by offering clear and transparent insight into the company's approach. During audits, tax advisors play a crucial role in representing the business, presenting documentation, defending pricing practices, and negotiating with tax authorities to minimize the risk of penalties or costly adjustments. Their expertise ensures that businesses remain compliant and protect their interests. Permanent establishment. A permanent establishment is a fixed place of business in a foreign jurisdiction that triggers tax obligations in that country. This can include branches, subsidiaries, offices, factories, or even an agent with the authority to sign contracts. Having a permanent establishment means the host country can tax profits generated by that establishment, which can impact the company's global tax position. 3 key roles of tax advisors in permanent establishments are permanent establishment risk assessment, strategic structuring to minimize permanent establishment risk, permanent establishment compliance, and profit attribution. Tax advisors help businesses assess their activities in foreign jurisdictions to determine if they create a permanent establishment. They conduct detailed risk assessments based on local laws or international treaties, helping companies avoid unintended permanent establishment creation. For example, while maintaining an office in a foreign country might constitute a permanent establishment, engaging in preparatory or auxiliary activities such as market research may not. To minimize permanent establishment risk, advisors recommend structuring operations strategically. For instance, using independent agents rather than employees to represent the company abroad can mitigate permanent establishment risk. If a permanent establishment is established, they also guide the attribution of profits based on the functions, assets, and risk of the permanent establishment, ensuring compliance with local filing requirements to avoid penalties. Withholding taxes. Withholding taxes are imposed by many countries on cross-border payments such as dividends, interest, royalties, and technical service fee, ensuring the source country collects tax on income generated within its borders, even when the recipient is a non-resident. These taxes are typically withheld by the payer in the source country and remitted directly to the tax authorities. The rates vary by country and type of income but are often used under double tax treaties. Tax advisors help companies minimize withholding taxes by treaty analysis and application, structuring cross-border payments, documentation, and compliance support. Advisors analyze applicable double tax treaties to determine whether reduced withholding tax rates apply. Treaties typically specify lower withholding rates for residents of treaty partner countries, and advisors ensure that the business qualifies for these benefits by assessing residency status and other criteria. To claim these benefits, advisors help businesses compile necessary documents, tax residency certificates, and affidavits. They also help structure cross-border payments efficiently in a way that minimizes withholding tax. For instance, they may recommend routing dividend payments through a holding company located in a jurisdiction with favorable tax treaties. VAT on cross-border services. Value-added tax or goods and service tax is a consumption tax applied to goods and services, including those involved in cross-border transactions. VAT on cross-border transactions is subject to complex rules that vary by jurisdiction. For instance, exports of goods are often zero-rated in the country of origin, meaning they are taxed at a rate of 0%. While VAT is applied upon importation in the destination country. For services, VAT is generally applied based on the place of consumption or the customer's location, meaning businesses may need to register for VAT in the jurisdictions where their customers are based. Tax advisors help businesses understand and comply with VAT obligations on cross-border transactions, ensuring accurate VAT registration, reporting, and credit recovery. Their responsibilities include VAT registration and compliance. Advisors assess whether a business cross-border transactions necessitate VAT registration in specific jurisdictions by analyzing whether sales volumes exceed registration threshold or if the company has a fixed establishment in the jurisdiction. Once registered, advisors ensure that businesses meet all VAT compliance obligations, including filing VAT returns, issuing compliant VAT invoices, and remitting VAT on time. Reverse charge mechanism and simplified compliance. For cross-border services within European Union and certain other regions, the reverse charge mechanism often applies, shifting the VAT liability from the supplier to the customer. Advisors guide businesses in applying this mechanism correctly. They also help them navigate simplified compliance regimes like the European Union VAT MOSS, that is the European Union VAT Mini One-Stop Shop for digital services, which allows companies to manage VAT reporting across multiple European countries through a single return. VAT credit and refund management. Advisors assist businesses in managing VAT incurred on cross-border expenses through tracking input VAT on foreign purchases and submitting VAT return claims in jurisdictions where the business is not registered. Digital and e-commerce VAT compliance. E-commerce and digital service providers face unique VAT challenges as rules differ widely across jurisdictions. Advisors provide guidance on complying with rules specific to digital services, including the European Union VAT MOSS, and similar regimes in other regions. They ensure that digital service providers charge the correct VAT rates based on customer location and comply with reporting obligations. In conclusion, the essential focus areas for any business with cross-border admissions are transfer pricing, permanent establishment (PE), withholding taxes, and VAT. With expert guidance, tax advisors help businesses minimize tax exposure, enhance compliance, and improve tax efficiency across international markets. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful,
don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.